You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome to A Smarter Way Home. In today's episode, we are going to be talking about a very cool mortgage strategy called the USDA Rural Development Zero Down Loan. I'm here this morning with my co-host, Mrs. Danielle Boote. How are we doing this morning?
I'm doing great, Victor. How are you?
I'm pretty good. I'm kind of excited about today because this product that we're talking about today is one of the, I think, most underutilized programs out there.
I think so, yeah.
Yeah.
Yet popular in certain areas, and an amazing financial planning tool to allow home buyers purchase a home and be smart about it financially.
And buying it with zero down. So what we're going to do is we're just going to discuss some very brief points that if you fit into this box, you may want to continue this podcast. But if these bullet points don't seem to be in your forte, you may want to look at another program that we have here on the website or tune into some future podcasts. But a couple bullet points on the USDA Rural Development Loan we want to discuss is, one, you don't have to be a first-time home buyer.
That is correct.
You have to have, all borrowers on the loan have to have a minimum credit score of 640 or better for all borrowers on the loan. And it's also going to talk about, it calculates the household income must be within county limits. The address eligibility must be in an eligible area, and we'll discuss that a little bit later. And you cannot have more money in the bank than, if you have the ability to put 20% down without touching retirement accounts, you really cannot, it's not designed to, so you can't really use it for that there. You can utilize this program if you are out 2 years out of bankruptcy or 3 years out of foreclosure. You cannot have any non-occupying co-borrowers. It has to be a primary residence only. A 30-year fixed-rate mortgage is the only available loan and term. And rates are actually comparable or better at times than a conventional loan. And it's for single-family units. You can do condos, but they must be Fannie Mae or FHA approved. Manufactured homes are allowed, but it's only for new construction. We'll talk about that. And you cannot own any other real estate unless you are selling a home. If you are currently going to sell a home, that home has to be sold, and then you can actually close the same day on a rural development loan. But you can only own one property. And there's some pretty cool stuff here. Danielle, what do you think about this whole program here?
Well, it's a fantastic program, and we have used it. I guess one other point is that there are no purchase price limits.
No purchase price
program.
limits.
It can go up to the conforming loan limit as long as the borrower qualifies based on the income guidelines. So this can be a good tool. For instance, when we talk about income limits, there are median income requirements based on the county that you're purchasing the home in, and it's also based on family size. So if you have a family of up to 4 people, meaning potentially 1 or 2 adults, a couple of kids, or over 4, and then it goes up from there. So if you have a large family, it'll allow for an increased income requirements.
Right. And also to our listeners or people on our website, you can actually see in the quick links or just below this video, we have a link to the income limits for your state and your county. That'll help you out there as well.
Mm-hmm, absolutely. But I've used this a few times for borrowers that are not first-time home buyers because maybe they have a house to sell. Maybe they have some debt that they want to pay off, and they can utilize the zero down and really look at changing their financial direction.
Well, let's look at that zero down, because people say, oh, it's zero down, I don't have any money to closing. Explain the difference between zero down doesn't mean zero cash to close.
That is correct. All mortgages require closing cost. In our area, you're going to have the cost to get the loan, plus the first year of taxes and the first year of homeowners insurance.
Okay, so for example, if I bought a $250,000 property with a zero down payment, and the closing costs were $3,000, the property taxes were $3,000, and the homeowner's insurance was about $1,000, I would have to come to the closing with about $7,000, correct?
Correct.
Unless seller concessions.
Yes, seller concessions are allowed on the rural development loan.
And what's the percentage limit on seller concessions where they can actually help the buyer pay some of their closing costs and or prepaid items such as taxes and insurance?
Rural development allows for up to 6% of the purchase price, not to exceed the actual cost.
Not to exceed the actual cost. And so that's a common question we get all the time. I thought this was a zero down loan. So for our borrowers, our potential home buyers out there, you're definitely going to work with your lender, work with your real estate agent, understand what the taxes are so your lender can help calculate your cash to close and or suggest a seller concession amount when we go to put that offer in.
Correct.
Okay. So as we talk about the rural development, it is only a 30-year fixed rate mortgage, correct? There's no 15s or nothing like that.
Correct.
Okay. And you can't own any other homes. Does, let's say you've got a property up north, you got a cabin. Does that mean you can't have that cabin as well?
No, if it's some rural development judges that based on could you live in it full time?
Okay.
So if you own, let's say, a cabin up north, and many times in northern Michigan, they're kind of rural in nature, don't have, year-round heating sometimes, and you certainly can't commute it from your job. So there are some exceptions that might allow you to still own a cabin up north.
Okay. And we just discussed a little bit briefly about manufactured homes. Set us straight on the manufactured homes and rural development guidelines.
Rural development does not allow us to finance an existing manufactured home on a piece of land. The only thing that they will allow is a new construction of a manufactured home attached to a piece of land.
Okay, very good. So let's move a little bit further here. So if you meet the criteria, you've got a 640 credit score, it is your primary residence, you didn't have a bankruptcy or foreclosure or that seasoning has already elapsed, I'm buying a primary home, I don't own any other homes here. Let's talk about qualifying purposes here. So now rural development is a government loan, and it's a great product, but there's always a fee to play with the government. Can you explain the funding fee?
Absolutely.
At all? What is a funding fee?
So with any government-backed mortgage, they're going to charge some type of mortgage insurance premium. There is an upfront rural development guarantee fee of 1% of the loan amount that is financed into the loan. And then there is also a monthly mortgage insurance premium that is a factor of 0.35% of the loan amount. So if we break that down, if you purchase a $200,000 loan, the upfront fee would be $2,000.
1% or $2,000.
So that would actually make your loan amount $202,000.
So I'm financing $202,000 over the life of the loan.
Correct.
Okay.
And then monthly mortgage insurance would break down to being $700 a year or $58.33 a month.
Okay, so I know on conventional loans that PMI goes away. On these rural developments, does that PMI ever go away?
No, the government loans that will stay on the life of the loan.
Life of the loan. But there's not a bad loan out there. They're all tools in a toolbox.
Correct. I mean, ultimately, think of it this way. If you are going to wait until you can save 5, 10, or 20% down while living in an apartment or a rental home, it's going to take you years to ever get there in most cases.
Right.
So think of the mortgage insurance as a opportunity cost to get you into a home sooner. I have seen many buyers I'll give an example here. My daughter and her husband bought a house in Howell 3 years ago, their first home, and their house has gone up in just 3 years significantly in value. So when I actually was able to refinance them out of the rural development loan into a conventional loan to get rid of the mortgage insurance.
And there is no early payoff on these government loans?
No prepayment penalty. So you could potentially refinance. But many times, if this is utilized by a first-time home buyer, they might only be in that house 5 to 7 years. So you're really not thinking, I'm going to live here for 30 years and pay mortgage insurance. It's a starter home purchase generally, and it's going to leverage you to purchase your next home.
And it also allows you, because you have low or no reserves in the bank, these are the tools that allow us to get into that particular property and have home ownership.
And for a lot of buyers, we're going to look at, okay, where's your budget? Where do you want your monthly payment to be? And what are you paying for rent?
Right.
If we can get you a house for similar, the mortgage insurance really isn't a factor, because let's look at the total monthly payment and how you can afford that.
Absolutely. I had clients in just last night, and a young married couple, and they want to buy a home, but they said, Vic, we don't have any money, and they're paying $1,500 a month for rent right now. And they say, I think I'm just going to wait. And I started to discuss with them some stuff. I go, okay, let's take that $300,000 home you want today. And in our county, we've had about 11% appreciation, but let's just say it was at an average over the last 20 years, about 5% appreciation. That $300,000 home this year, next year will run $315,000, meaning they got to save $1,250 a month after payroll taxes just to keep up with appreciation. And I asked them, how much do you save a month now? They said about $400 or $500. So they're actually going to be further behind next year. And then they said, well, we don't have the cash and we can't get any gift funds from mom and all that. And then I started to discuss the potential of seller concessions. And working with a good real estate agent can help execute a winning offer to have the seller pay for some of those concessions there. So.
Sometimes that's an option. It's certainly a little bit more challenging these days.
And why are these government or rural development offers a little more challenging?
Well, it's hard to get seller concessions right now.
In this seller's market.
In this seller's market. Not completely out of the question, but certainly a seller's gonna, if a seller has multiple offers on a property and they see someone with zero down that doesn't have any money for closing costs, they're probably not going to think that they're as strong of a buyer. But that kind of boils down to the strength of who your loan officer is and the relationship that they have with the agents. I think you had told me a story recently, or somebody did in the office, I'm going to forget who, where we had a buyer's offer accepted on a rural development loan in a multiple bid situation because they were going, the buyers did have money saved. They were going slightly over asking price and they wanted to put in an appraisal guarantee. And we got creative with that and said, look, this buyer could do, for instance, a $5,000 appraisal guarantee and pay their closing cost if the seller would accept it with a rural development mortgage, because then we're not eating up money for the down payment. We're eating up the money for a potential appraisal guarantee, and the offer was accepted in a multiple bid situation.
So in that situation, that borrower working with that loan officer anticipated if we have a roadblock or if we have a hurdle, we've got the means to take care of that.
Right. And the borrower was well qualified. So the buyer's agent communicated with the seller's agent and said, hey, this buyer is strong, but here's what our strategy is. What do you think? And they wrote a strong offer, and it was accepted, even though there were other offers that were probably not rural development.
And I've submitted many rural development offers. And working with clients, you may want to have, if possible, you have 1 to 2 to 3 different options where, could we potentially go with a conventional offer, and we'll talk about that, versus a rural development. So we go in with the rural development offer first, and if they don't accept it because it's rural development, then we switch it around to maybe an FHA mortgage with some down payment and or a conventional mortgage.
Right. Right. Now, another, thing that people think about with rural development is that it's an easy program to qualify for. And rural development is tougher to qualify for than FHA, and in some cases even a little bit tougher than conventional. So let's talk about the debt to income ratios and how that works, because it's important to understand that somebody that does get approved for rural development has got to be pretty strong.
Right. So now let's go ahead and talk about the debt to income ratios. So now, debt to income ratios on a rural development, right now the basic ones are 29 and 41. Can you explain to our listeners what the debt to income ratios are? What is 29 and 41? Explain what debt to income ratios are.
So what we look at is what the total income is for the household, and we divide it by what the new house payment is going to be. For starters, and that is what we call it, the top ratio comes from, or the 29%. So rural development does not want a buyer to spend more than 29% of their pre-tax income on their house payment. And the bottom number, or the 41%, is the house payment plus any other debt that the borrower has, which would include car payments, credit cards, student loans, any other installment loans that would show up on the credit report. It does not include things like your utilities, phone bills, electric, gas, things
And that's
of that
why
nature.
they keep you to 41%, because they know, one, part of your paycheck goes to the government for taxes, the other part goes for food, gas, clothes, miscellaneous, and utilities.
Correct. So if you have a credit score between 640 and 680, rural development is going to be pretty strict and said you have to be at 29 over 41. They're not going to allow it to go over that.
Okay, so I'm a borrower. I'm listening to this podcast. I've got my calculator here. So I take my gross household income and I divide it by 12 months, and I take 41 or 29% of that, and that's my max house payment that I can use for my qualifying income.
Correct.
And then 41% of that gross monthly income is for my housing expense and all my other debts.
Correct.
Okay, let's talk about a little bit more about the incomes, because how you and I may calculate someone's income may be much different than how an underwriter will calculate income here. So let's just talk about what type of incomes, bonuses, overtime, commissions, can they be used? Let's just talk about a little bit of the income.
We can use variable types of income as long as there is a 2-year history. Now, here's the interesting thing about rural development. They're going to look at income 2 ways. We look at one for qualification purposes, and the second way we're going to look at it is for the total household income calculation. And this is where things can kind of get tricky. We're going to qualify somebody off past income. So we might use somebody's current hourly or salary rate, and then we'll average any variable income, which would include bonuses, overtime, commission.
If that bonus, overtime, or commission has been received for the last 2 years.
Does not have to be the same job if they were in the similar line of work. But if they have a history of overtime and started a new job 6 months ago, we can still use that overtime, but then we'll average whatever the current position is. But the challenging thing with rural development is they also look at total household income.
Okay.
And sometimes when overtime for instance, is very strong, they may project that they're going to make more money than they have in the past.
So rural development, we can calculate our income, but rural development is going to look at that income and say, wow, they have bonus and it looks like it's going to project out and it could go over the limit.
Correct. And if it goes over the limit, they may not be eligible. And we've run into that a couple of times over the years with borrowers that are heavy overtime, but only certain times of the year.
Right.
So let's say you have somebody that is a seasonal worker and their unemployment rolls 6 months out of the year, and the other 6 months it's just 40 hours a week. Right. So if we're trying to do a mortgage during their heavy overtime season, it may be projecting that they're going to make a lot more money when they're really not. And then that can get a little bit tricky to verify.
Yeah, so I work a W-2 job, but I've had a part-time job for only 1 year. So we can't use my part-time income, but rural development is going to use account it to project what income will be made.
Correct.
Yeah. So income with rural development gets a little tricky. Not that it can't be done at all. It's just you really need to take time to discuss with your loan officer. And if you click on the preferred lenders page of assistmyrealtor.com, you'll come to the page there and you could pick either Danielle or I, or we have several certified mortgage advisors in our office that you can contact and go ahead and discuss those incomes. But the number one thing is do this homework up front before you go out shopping so there are no surprises.
And we need all income sources disclosed for a rural development loan, which would include child support, alimony, Social Security retirement or disability, pensions, even dividend or annuity income. That all can be used for qualifying, but it will also be used to verify the total household income.
And with rural development, they will require 2 years full federal tax returns so we can see all income.
Yes, and they also want to know, what's different on the rural development application is that whoever's buying the home has to make a statement of who lives in the house. Mm-hmm. So let's say you have a couple and mom is going to live with them, and mom's retired, or grandma's going to live with them, and grandma gets Social Security. They are required to disclose that, and then that whatever income grandma's receiving is going to be calculated in the total household income,
which could take them over the limits.
So there's a little bit, more there. For instance, on a conventional loan, if you receive child support for a child in the household, we don't have to use that to qualify if you don't want to. But on a rural development loan, it has to be disclosed as total household income.
We have to report all income.
Yes.
Okay, very good there. So let's talk about credit a little bit. You were discussing, when we talked about debt to income ratios, 29% for the housing expense and 41% for everything else, including the house and everything that's on my credit report. And I have student loans, but I don't have to make a payment. It's a zero payment right now. How does that work with rural development?
Well, rural development is going to require that we qualify the borrower with a minimum payment of 0.5%.
And give me an example. I have $50,000 in student loans, but I don't make a payment. What are you going to calculate to count against me towards those ratios?
$250 a month.
$250 a month. Unless I have an income-based payment plan that I can get in order and sign up and show the paperwork.
So right now, what we've had to do with several clients is get them out of the CARES Act forbearance back into what's considered a repayment plan, even if it's income-based and there's a zero payment. Because if they're in forbearance, we have to use the 0.5% calculation otherwise.
Yeah, so we have to count those student loans against you. So now let's also talk about, credit. Okay, I've got a 640 score. What are the minimum amount of active trade lines? Can you explain what an active trade line is? What's the minimum requirements for repayment or on your credit?
Yes, so an active trade line is an account that is open, being used, and being paid in a timely manner. Rural development requires that we have 3 active accounts that have been open for at least a year. Okay. So this could be a car payment, a credit card, a store credit card, student loan, something of that nature. But they want to see that the borrower has a history of managing their money and paying bills in a timely manner.
How does rural development look upon collections? There's medical collections and there's other type of collections. Could you discuss a little bit about how do they look upon collections?
Typically, all but medical collections should be paid off, and they're going to look to see if these collections have been paid off in the past 6 months. Okay, because I know rural development, some people say, well, I'm going to pay that off before I close, and rural development kind of looks at it and say, look, you didn't pay it off before, but now you're buying a house and you're willing to pay it off. Right.
So we want to show a pattern that you've come to the plate, you've paid off that collection. But how do they treat medical collections? Do I have to pay them off, or do they kind of just void them out? How do they look at that?
They don't look as heavily at medical collections as long as it's under $2,500.
Okay. So let's say I do have other type collections in there for a few $1,000s or whatever it may be. Am I allowed to enter a payment plan and get a record of trying to repay these back because I don't have enough to pay them in full?
Right. You can, but then you've got to have a 3-month history of making payments on time.
So again, this pays to get in to speak to a loan officer, get your credit, understand all the stuff, and plan ahead and get everything in order there as well.
Right.
Okay.
And one of the things that we didn't talk about when we were talking about ratios is that the higher the credit score with rural development, they will give us a little bit more flexibility.
And why is that?
Well, they feel that if the borrower has demonstrated that they can pay their bills on time, they'll allow a slightly higher debt to income ratio, not dramatically.
Okay.
They'll let us typically go up to about 31%
on the housing ratio.
On the housing ratio, if you're over 680, and up to about 44% on the back end.
And also there's the payment shock. And one of the reasons why they keep us lower at 29 and 41 ratios is payment shock. And what that means is someone may be living rent-free at home or something like that, and now they're entering a payment that could be $1,000, $1,200, $1,500. There's a payment shock.
Right.
So above that 680 credit score, rural development seems to say, hey, I can pay my bills. We'll allow that because that's a compensating factor.
It can be, yes. Yeah. And one of the things, when we do a rural development loan, we run it through their guaranteed underwriting system, which is called GUS, is the acronym that we use. So GUS is the one that will give us the hopeful green light that we can go ahead and get somebody approved. So some scenarios, there are very cut and dry guidelines, but then when we run it through GUS, it reads the whole file and then tells us, yes, we'll allow this. We'll allow slightly higher ratios, or no, we won't.
Okay.
Based on the strength of the borrower.
Absolutely. A question here, because gift funds. Are gift funds allowed on rural development?
Gift funds are allowed for the closing cost.
And can my friend give me the gift? Who are the eligible donors?
Eligible donors would be family, or people that you have a bona fide documentable relationship with. So a fiance could give a gift if we can prove that the parties are engaged.
By what? A wedding invitation?
It could be a wedding invitation. It could.
What about a Jared? He's got a credit trade line of Jared.
Yeah, he bought the ring at Jared.
So
yeah,
a receipt
that could
from a wing or something.
Yes. Yeah.
Okay.
Or if they live together, then we can prove that they live together already. Again, we'd have to document the non-borrowing fiance or something of that nature. But gifts could be allowed.
And I understand that on rural development, an employer can actually gift as well.
Yes. Yeah. I actually had something similar recently with an employee that worked for AAA, and they participated in some bond program in Wayne County that allowed the buyer to get some money for closing costs.
Wow, that is really cool there.
Mm-hmm.
So let's go back a little bit. We talked about that offer that you put in on rural development with your buyer with an appraisal guarantee. Now, in a conventional or an FHA or a VA loan, lenders are going to lend based off the purchase price or appraised value, whichever is less. What happens on a rural development if the appraisal comes in higher than the purchase price?
Well, that's a unique feature of this program. Rural development will allow a buyer to finance up to $5,000 in closing cost or repairs if the appraisal comes in higher. So if you have a $200,000 purchase price and the appraisal comes in at $205,000, you conceivably could roll in $5,000 worth of closing costs into the loan.
So if I had, go back to that scenario we talked about on that $200,000 purchase, if I had with my closing cost and my taxes and insurance were $6,000, but the appraisal come in $5,000 higher than asking price, I could roll in $5,000 of that $6,000 I was coming to closing with.
Yep.
And come to closing with $1,000.
Correct.
That is
Correct.
a very cool tool, but don't plan on it.
No,
right?
I always tell everybody that you got to have the money saved. We're not going to give you a pre-approval letter on the hope and the chance that the appraisal comes in higher. That's not good financing strategies right now in this market. Sometimes it comes in higher. Sometimes it only might come in $2,000 or $3,000 higher, but that can be a big difference for a buyer. For instance, maybe they want to put new carpeting in or painting or something. Everybody's going to probably want to do some kind of home improvement.
Absolutely.
This gives them a little nudge there. Also, rural development gives us a little bit of flexibility if the house needs repairs. They will allow us to escrow for repairs up to 1.5 times a bid for repairs. So I've had, over the years, I had a house that needed a new roof. We were able to get a bid from a roofer and escrow for the money and have the roof replaced right after closing.
Is that all season long or only during the frost loss?
All season long on rural development, but here's the kicker. The work has to be done within 30 days of closing.
Okay, and the buyer cannot do any of his own work?
And the buyer can, believe it or not.
Really?
Yeah, it's the only loan program that will allow the buyer.
I didn't even know that.
Yeah, but the bid has to be from a licensed and insured contractor. So with my client, we had... she was getting a good deal on the house. We were able to roll in the repair escrow, and her dad put the roof on. Right. So they ended up, and then the funds were released after closing. We just have to have an inspection that said the roof was done. Now, right now in this market, it would probably be a little challenging to do that because contractors are so backed up.
Yeah.
Could something be done within 30 days? That I would say is a case-by-case conversation that you would, have to discuss with the loan officer, look at the property and say, okay, what needs to be done? We're not going to rebuild a house for $5,000.
Yeah, absolutely. So this is basically for health and safety issues. And as we talk about health and safety, let's bounce back to the appraisal. Let's bounce back to why a seller may not consider a rural development offer. And this comes down to the rural development appraisal. And the government, as good actually as they are with loan programs, they want our home buyers to have a, reliable, energy efficient, just a decent home over their shoulders there. So they have the health and safety inspection list. Can you explain what that means?
Well, rural development follows the same appraisal standard as FHA. In fact, they didn't write an appraisal standard for the rural development guidelines. They just said, we're going to follow what FHA does. So things that an appraiser will be looking for, first, they're there to appraise the value of the property and the condition of the property, and they're going to look for health and safety issues. The biggest thing we see is peeling paint. If a home was built prior to 1978, it may or most likely has layers of older paint that could be lead-based. Okay. So if the paint is flaking, chipping, or otherwise coming off the house in any way, shape, or form, that would be a health concern. So those things typically have to be corrected.
And why is that a health concern? So I don't go out there eating the paint chips off the ground?
Yeah, eating paint chips would be hazardous to humans, especially small children and even pets.
Right, absolutely. And also you can get that appraisal, inspection checklist right on the website under rural development. We have a link for that so you can see when you go inspect these properties, you just go down the checklist and look what they are looking for. But they are looking for cracked and peeling paint. They are looking for windows without screens. They are looking to make sure we have handrails on there. They're making sure that there's no major trip hazards or a lot of cracked concrete. Not that we can't do crack concrete, but so they're looking for those type items, correct?
Correct. Yeah, the concrete would have to be dramatically heaved over probably a 2.5 inch.
The biggest one I ever see, is the cracked and peeling paint and ground fault interrupters, receptacles you got to have in the bathrooms. We see that quite a lot.
In older homes, they may not have them,
Loose and hanging wire in the basements and stuff like that. And on decks, too. A lot of decks, are bare wood or they're peeling in that. So, and does that stuff have to be fixed prior to closing?
In most cases, yes. There are some cases that we can escrow and have the work done after closing.
Okay, so now a lot of times I'll see a seller or the listing ticket where it says, yes, they're taking rural development financing, but they don't even understand what the government appraisal checklist is. Is it wise for a buyer and the real estate agent to look at this when they're looking at the home and present this to the realtor and saying, we've identified some things that could be a health and safety concern? What would you advise there?
Well, it really depends on market conditions. If repairs are called out on any government financing, the option can default either to the seller to take care of a certain amount or a buyer to take care of a certain amount. Usually the realtor will put in the government addendums in a purchase agreement how much the seller is willing to repair. It could be zero. If the seller says, you're buying this home as is, I'm not doing anything, this buyer may say, okay, I'll take care of up to $500 worth of repairs or something of that nature. Okay. So I have seen situations where, for instance, maybe there's chipping and peeling paint on outside window frames or something in an older home, and the seller will allow the buyer to do it prior to closing. So we prefer to have repairs done prior to closing, but there are avenues where we can escrow it.
Okay. And would an example be as I'm doing this in December and we have cracked and peeling paint? We can't paint in
Michigan in December.
So what happens in that situation, and what is an escrow holdback? How is that organized?
Well, an escrow holdback would be taking a bid from a licensed and insured contractor and holding 1.5 times the amount of the repair. So if a bid to repaint was $1,000, we will hold $1,500 in escrow to make sure that the work is done. And then the work's got to get done pretty darn quickly, after closing.
And then once the work is done, that original appraiser is called back out to reinspect to make sure we've met all health and safety standards?
Correct.
Okay. And so with the government loans, there's always the government appraisal checklist. And potentially some sellers may not want to utilize that because we have an older home and it may have something. And this is more to even talk to your loan officer about option 2. Do we have another option in the conventional loan arena that doesn't, we don't need the health and safety check? So,
well, definitely conventional is a little bit easier on appraisals, but not always.
Right.
If a house has a bad roof, it could get called out on any loan program. So it's really a case-by-case situation. And I think the biggest misconception boils down to what the listing agent thinks about the house. Yeah. I've had listing agents say, oh, no, this is not going to go government. They have concerns. And, I've actually gone out and looked at houses for my clients with the realtors to say, okay, is this going to fly with rural development or FHA or VA? And sometimes the listing agent doesn't really know and they're concerned, but then we'll look at it and go, we got a chance, let's try it. And then we end up getting an appraisal with no concerns whatsoever. Yeah. Just because a house is old doesn't mean it's bad and it can't be financed. Again, are we looking at cosmetic things? Linoleum from 1974 could still be in good usable condition. Absolutely. It's just not the current fashion. Right. So that's not going
we don't care how pretty it is as long as it meets minimum health and safety.
Correct.
Because the government wants our buyers to have a good, safe,
livable now home. If the linoleum is peeling or it got holes in it, that's a different story.
Yeah, it's kind of interesting. Do you have any other stories or any other advice? What would someone do to say, hey, I want to see if I qualify for this rural development
loan?
Well,
as we've talked about on our previous podcast, the first thing any prospective home buyer needs to do is to talk to a loan officer. And let's review all of your situation, your income, your assets, your credit, and we'll be able to determine what the best loan program is for you and why, and then communicate with your realtor so they can do the best job at finding you the best house and negotiate the best offer, as well as we do a lot of communicating with listing agents these days.
Absolutely.
Right? To say, hey, our offer is coming in and the buyer's strong and here's how quickly we can close. We can still close a rural development loan in 30 days.
Yeah.
With a well-prepared buyer that cooperates and gets us documents.
And also, a well-prepared lender that has documents. So let's talk about the documents. What does one need to gather to actually have that phone call or actually meet face-to-face with a loan officer, which I technically prefer? But what are those list of documents that we would want to prepare for any lender?
Typically, what we're going to need is 1 month worth of pay stubs, 2 years worth of W-2s and tax returns.
From all borrowers.
All borrowers.
Okay.
Including for rural development, it's going to include all household members.
All household members.
If there is, for instance, an adult that's in the household that has income. And 2 months worth of bank statements.
2 months and driver's licenses.
Driver's license, yep.
And if you collect Social Security or Social Security award
Award
letters,
yep.
any income you have.
Correct.
You know, and especially if you are part-time, overtime, bonus, you've had some job jumping over the last 2 years, these are where the complexities come into the equation, and you need to work with a true professional to sort everything out and make it make sense here.
One of the things that we'll do frequently with pre-approvals, if we have a borrower that has variable income or has had more than one job in a few years, we'll actually verify with their previous employer or their current employer. One of the processes to get a loan is getting a verification of employment, written documentation from the employer that this is what they make, here's what their overtime is. You know, if we have concerns, we'll request those before we issue the pre-approval to make sure that we have got the income verified and ready to go, and then it's solid.
So this isn't where you call your lender at Friday at 4:00 and say, I need to put an offer on this by 7:00 or tomorrow morning on Saturday, because it's just not that we haven't done that.
Yeah, we've done that.
Yeah.
Well, we have to, but
you know, but it's really to your benefit to get everything together, understand the program, understand potential cash to close or potential strategies to minimize cash to close, so you, us, and your real estate agent can prepare an offer to execute with precision.
You know, one of the things that I find with prospective buyers is they don't always know how to get their documents these days. In the digital era that we're in, everybody gets a pay stub, everybody should get a W-2, and everybody gets a bank statement. But most people, frankly, don't know how to access them because it's through an app. And people will say, well, there's this app, but I've never downloaded it and I've never used it. So we literally have to send them to their HR professional at work and say, get that app, download it. That's where your pay stubs and W-2s are going to be.
I get that a lot when I say, hey, do you have a retirement account? And I say, how much you have in there? They say, I don't know.
Yeah.
I can't access it.
Yes,
You know?
yeah.
I would think you want to pay attention to your 401k.
Yes,
know?
or even your bank statements.
Yeah.
People don't look at bank statements the way they used to. You should have an e-statement online, but very few people use it anymore, so they don't know. So that takes time. And if you're calling at 5:00 on a Friday and we got to tell you how to get a hold of your HR person to get a pay stub, we're going to struggle a little bit there because you're not prepared and you don't know. So know how to get your documents. The other thing, too, with everybody doing TurboTax, almost nobody prints their tax returns anymore. And they don't know how to get back into TurboTax to get a copy of the tax return.
Yeah, I'll say, hey, go get them from your accountant. They say, I'm the accountant.
I don't have an accountant. It's TurboTax.
And I forget.
TurboTax is great.
And I forgot my password to TurboTax.
Yeah.
We get that quite a bit.
So, if you think you're going to buy a house, save your tax return every year. Yeah. Save it, download it, stick it in a folder on your computer or something like that, because those are documents that you need to have access to.
So you really need to mark that down. We need 2 years tax returns, 2 years W-2s from all jobs, last 30 days pay stubs, 2 months bank statements, and your driver's license. And we need that information for both borrowers, or how many borrowers you have on the loan. And we will need W-2s potentially and tax returns for anybody else living in the house that actually gains income.
Correct.
Okay, so do you have any closing words or anything about this rural development loan that you want our listeners to understand or know about?
It's a great program. It's in the majority of the state of Michigan is eligible for rural development. Areas that are not are going to be too close to the city. So for the most part, very little of Wayne County is eligible. Only the northern and western parts of Oakland County are eligible. In Washtenaw County, the city of Ann Arbor and Ypsilanti are not eligible. But if you get into those township areas, again, you think rural, it's all based on population density. So it really depends on where the borrower's looking.
You know,
So
and on the Assist My Realtor site or below this video, we're going to have another quick link with the video showing you how to utilize the link on the address eligibility. You just plug in the address and it'll tell you if it's eligible or not, or you can just zoom in on Michigan or any state you want, and the white areas are eligible and the cream colors are not.
correct.
And it's a pretty simple tool if you think rural development is going to be a tool for you. I actually bought my first home. I got in the mortgage industry because of rural development. Because when I got back from overseas, I was absolutely broke. And I looked in the phone book, called the lender, did the rural development. And I remember at the closing, I had to come with 10 cents to the closing.
Wow,
and
10 cents.
I gave the girl a dime and she says, we can't take cash. So I remember distinctly we had to write a check for 10 cents.
Oh my, that's
because
weird.
we negotiated seller concessions and it
10
just
cents off.
Yeah. So yeah, it was 10 cents. I had to come to the home, and that was amazing. And that's what got me interested in the mortgages and this program.
Our first mortgage was FHA.
Yeah.
Yeah. So these programs really, really assist the majority of first-time homebuyers, and that's why they're there. It's not a bad thing.
Oh, they're great programs. It's the best thing since sliced bread.
Yes.
Technically.
Yeah.
And you don't have to be, let's say I sold my house today. I could go utilize another rural development mortgage if I meet the criteria.
Correct.
You know, it's just a great tool. And my daughter's going to be buying a home soon, and my son, and we're going to hopefully, or we should utilize the rural development loan on them too.
Well, they have great interest rates, right?
Yeah.
The interest rates are sometimes lower than conventional.
Yeah.
Depending on what your credit score is. So you look at that combination, especially with today's low rates, you know, we're seeing buyers get pushed out of renting because rents are going up so high. And actually by buying a house, you can help not only build equity in the future, but protect your household from increasing housing expenses by becoming a homeowner, if you're ready for it.
Excellent here. Any other closing statements or something we haven't covered about this rural development loan?
I think we've covered a lot of things, haven't we? Anything that you can think of.
Okay, well, if you just browse through the assistmyrealtor.com website, you can go to the preferred lender page and you can see our contact information and other loan professionals we have working at the company, and utilize the quick links. There's a lot of tools to help you, the home buyers, working with us, working with your agent to prepare and execute a winning offer. Is that a correct statement there, Danielle?
That is a correct statement. I would agree with you there, Victor.
And with that, we will see you next time. And if you have any questions or concerns, you can email us info@assistmyrealtor.com. I'm Victor Bals, and
I'm Danielle Boote.
And we'll see you next time here on A Smarter Way Home.